Thanks, Marat, for that kind introduction. I'm happy to be with you guys today. So I entitled my speech, The Developing World Empty Nest Syndrome. The chicks, the developing world, have flown the coop and now are flooding the market with steel. And we've heard this theme a couple of times today already. So we'll discuss it a little bit more as we go through. So, and I'm going to go through the economic slides really fast. You have to start, from where are the economies, because obviously it's consumption that drives our industry. And we had a period of pretty high growth, and now we're in a period of not so high growth, and that's been kind of discussed at length so far today. One of the things that, as an economist, I'm basically an industrial economist. I've worked on Wall Street as a financial analyst, but maybe 20 or 30 years ago in school, we studied the K-wave, which was developed by a Russian economist talking about a cycle that's about 40 to 60 years long. Nobody really knows, but it's really kind of driven by the world economies growing in sync. So thankfully, in the last 10 years, we've had this really nice period where most of the economies were growing in sync, and unfortunately, recently, they're not. And so that's part of what we're feeling as we're trying to manage our businesses through a more challenging demand market. So even the growth that we have doesn't feel very great. I tell people probably in the history books, when we look back at this time period, people will say, oh, that was a kind of stable growth. It wasn't very high, but it wasn't very low. Unfortunately, when we're living through it, it feels a lot differently. And the economies feel very vulnerable. Business needs predictability to make aggressive moves and for expansion. And our world is just consumed with lots of unknowns. I put a couple of these on here. The global banking system, Lars talked about this at the beginning of the session. Most of the money that's been created and the flexibility that's been created shored up the banking system. It didn't really shore up the economies. It fixed a problem because we had a problem in our banking system that wasn't properly funded. But in truth, we didn't really see the benefit of that. And in fact, George Soros recently was talking about current instability in the EU system. So there's still concern that the financial system is not as robust as it needs to be. The second thing is oil. And we haven't talked too much about this today, but it's been in the news a lot. Oil drives a lot of the developing economies. And right now, the income from oil is really down, which has caused their economies to be lower growth. Brexit, there's lots of uncertainty about Brexit. I think at the end of the day, if in fact London is the financing hub of the EU, the more that those bankers are not allowed to effectively do their business, again, it's just going to slow things down. If it takes me twice as long to get through customs or whatever it is, I'm not as effective as a banker, so therefore I can't get as much business done, so therefore not as much business gets done, and the economy slows down. And then finally, I put on here the USA election just because there's lots of uncertainty. Nobody really knows what's going to happen. And so as a business, my practice when I came out of World Steel Dynamics was to try and focus on strategies and to help managers make decisions on how to run their businesses. And if there's lots of uncertainty, I'm going to delay the decision, right? As a manager, you're never going to have all the information you want, but you hope that you won't find out 5 minutes after you made a decision that it's a bad decision. Right, so you're going to wait until you get a little uncertainty. Okay, we've talked about this earlier in the day. About half of the world GDP is still coming from the developed world. The top 10 economies represent 2/3 of GDP. Interestingly, last year, South Korea displaced Russia in the top 10. I left both of them on here, so you'll actually see the 11 flags before other. But again, there's a fair amount of concentration in the global GDP. And I assume, Marat, you're going to make these slides available to people, right? Okay, if not, you can get them through me. So here's our new challenging macroeconomic world. We have less homogeneous economic growth. China's decision to shift back to a consumer-based economy stalled growth in many areas. I know we had that discussion earlier today. If you go back 15 years ago, the Chinese economy was about half and half of consumer versus industrial growth. So I have no doubt they can do this. It's a command economy, but there's some dislocation as you go through the process. One of my hats, I'm an economist. I studied economics undergraduate, and I had a client last year who asked me to handicap what the Fed was going to do. So I went to a lot of meetings with a lot of federal governors and a lot of economists, and basically business economists were saying, senior level business economists, that a lot of the moves that they were seeing out of China reminded them a lot of the moves that we did in the US in the 60s. So they've got levers, they're trying to figure out how they work. You know, you have some successes and you have some failures, and it's a process. So currency instability, and we'll talk about currency too in the steel industry, because a currency move can significantly impact the productivity and the competitiveness of a steel mill trying to sell into the global market. I think there's going to be a commodity oversupply for at least another half decade, which is obviously shifting the pricing power away from the mills. And of course, and we've talked about this, everybody knows this, everybody's kind of protecting their markets now, more from a mercantilist perspective. It's interesting because there's a lot of conversation now about the move away from globalization. I mean, the truth of the matter is we are global. It's just a reality that we live in. We're not going to be able to go back to independent countries. It just doesn't work that way. So I threw this slide in here. We do have higher cost energy with the gas, oil, shale finds. Right now it's down because obviously Saudi Arabia took the prices of oil down, but we are choosing mostly as a globe. We have environmental relationships. We have treaties now saying that we're going to protect the environment. So we're doing things that are moving away from the lowest cost production to higher cost production because we're valuing something other than just the creation of the energy. And that's fine. It's just a truth that you need to take into consideration when you're making decisions. The oil market, I think it's going to remain volatile until the Iranian supply becomes reintegrated into the global supply system. I put a couple of trends up here. The U.S. shale discoveries in 2011, financial risk. Saudi Arabia took the prices down because they were really tired of any oil project that wanted to get funded could get funded. I think once they took the oil price down, the income shifted around the globe, and they found that it was actually in their benefit to take more money out of the oil, less money out of the oil market because other objectives were being met, namely the funding of ISIS. And also, you know, Iran now has cleared their inventory, but some of their assets are still old. They really haven't had a chance to invest now that the trade barriers have been reduced, and they're having issues financing. So, and they're working on changing those issues. So for sure, they're going to continue to be a bigger player in that market. And in fact, there are sessions going on right now that have been in the news about some of the impacts of this. So I have to tell you guys, I made this chart for this conference. I don't usually talk about oil. And at 8 o'clock this morning, I was adding Algeria because I didn't have them in that mix. So you don't know what you don't know until you know it, right? But the truth of the matter is this is the way the production looks. The U.S. is a significant producer now of oil. We're not a significant exporter. It's really Saudi Arabia and Russia that are dominating that. But you have a lot of little players, and this is part of why OPEC is not really working right now, is because it's like herding cats. You guys all know how that works. What was interesting, and we've talked about this number for years in my career, but $50 barrel oil above 50 is where there's actually excess revenue generated that can really drive growth in an economy. And in fact, on the news this morning, the Russians were predicting the $40 barrel oil price for the next few years, 3 to 5 years is what he said. So basically what that tells me is that there's not going to be excess income to fund certain economies. So again, I'm not saying good or bad, I'm just saying these are the things we need to know to be able to make the decisions to run our companies, right? All right, so let's talk about the global steel mill highlights. Our steel industry, we talked a little bit about this. Let's talk a little bit about this. The world's oversupplied, we know that. Demand is okay, but it's not superb. All of the markets are not growing in sync right now. You guys probably know that. Pricing globally has been falling because raw materials are falling and quote unquote cheap imports. I think in the West, at least in the US, I know, we use lots of terms because we can, and it's not really, we're not integrated as much in the world as other countries are. So we can kind of say things that nobody really challenges us on. So we tend to kind of be, I don't know, we're centered in our own little world. The commodity cycle is going to be in a protected price bottom here. I think actually somebody else has already spoken to that. Kim, I think, spoke to that a little bit. But what I'll say, it's so fascinating because everybody's like, oh, doom and gloom. These are all the same conversations that we had, at least in the US, in 2001 and 2002. It's the trough of the cycle. It feels bad. There's overcapacity. It's the trough of the cycle. This isn't really anything new. The question is, how do we get out of it, right? And eventually, demand is going to come back. And eventually, supply and demand will come back in balance. Eventually, the question is, when is eventually? All right, so this is just world crude production. Again, Kim put these numbers up. I have to tell you, production was down last year. Everybody knows that. I was predicting that production would be down about 1% for most of this year. In the first half of the year, it was down 1.5%. In July, it was up 1.5%. Kim showed you that. The August numbers were out 2 days ago. It was up 1.8%. So I was on the plane going, well, if the second half is up 1.5% and the first half was down 1.5%, what is it going to do? Is it really going to hold? Is the nice momentum that we've got here, is it going to hold? So I'm a little bit ambivalent, but I think ultimately it's going to be about flat. This is just the World Steel Association forecast. Kim put this up. This is just another way to look at it. In April, they were predicting a 0.8% drop year over year. But it's interesting because regionally, there's some regions that are stronger than others, and you guys are from those regions, so you probably already know that. Okay, so here's the point, and it was interesting because Mr. Lee made this point too. The colonial model has fallen, and that's what everybody, at least in the West, is groaning about, because it used to be we would produce the steel and we would ship it far away and somebody else would use our steel. We would supply our own markets, but we had access, and we would basically then count on the world's excess demand to fill up our mills. That's not going to happen again. It's just changed. You know, China, when China was carrying us in 2008 and 2009 and the whole world didn't implode, I mean, we were imploding financially, but it wasn't as bad as it could have been. We didn't say, oh, thank you so China for saving us. But now that the world has slowed down and their economy slowed down and we can't ship our steel to them because they have their own steel, we're all like, oh, those horrible, horrible China. I had one presentation where I had Darth Vader. You know, the end has come. They're creating all these problems for us. Well, the truth of the matter is the world's just changed. The market that we had, because nobody else could produce their own steel, has changed. Now they produce their own steel, so we have to adjust in how we compete in that market. I put the East India Trading Company on there, this logo, because, you know, pirates are gone and global trade is not dominated by one country anymore. Okay, so this is interesting. The top 20 producing companies are about half of global steel production. You look at the industry, and it's consolidated on some levels, but it really hasn't yet. If you think we're at 1.6 billion tons of steel a year, really ArcelorMittal is what, 100 million tons. It's not even 10%. And even with the Baosteel-Wisco merger, it's still going to be about 10%. So that would be the top two producers have 20% of the market, and then it's broken beyond that. Down 80% of the market is still not consolidated. Also, this list has changed, obviously, in the last 10 years because half of it now are Chinese companies. And it's also interesting because the size of the company that you need to be to make the list has continued to increase, which is bad for like a steel mill that's only producing 1 million tons a year. But it's good because they don't have too much stuff to sell, but it's bad because they don't really have the power that they used to have because they're more irrelevant. All right, so we're in Europe. So I threw in just a couple of slides here on Europe. You know, Germany accounts for about 1/4 of the EU crude steel production. It's still, well, it's pretty consolidated. Half the chart is with 6 or 7 countries. 3 of the top 5 EU producing countries reported down results in 2015. So again, this is going back to what's driving it. Is it overcapacity? Well, in every trough of the cycle, there's overcapacity. So I'm going to make the case that it's really demand. If demand were strong, then we would be having a completely different discussion. And again, EU steelmaking is only operating at 79% of capacity. USA, again, just because I love this, I don't know how much this is relevant to you guys, but I live this, so the capacity utilization in the US is still at historically low levels, which has proved challenging for how we manage our steel production. Okay, so, and as Mr. Lee already talked about, global overcapacity is not just a developed world challenge. At the moment, it's a challenge for all of us because, again, our demand and our economies have slowed down. But I'm going to make the point again, it's a trough of a cycle. In every trough of a cycle, this is what you have. The OECD is predicting a 30% overcapacity. That's not something that's going to be fixed anytime soon, obviously. At World Steel Dynamics, it would be funny if you guys know, Peter Marcus would always say, oh, these blast furnaces need to close. And Carlos Kiersis would go, whose? Who's going to close their blast furnace? Really? Because there's just not a lot of discipline in the industry. It's not you don't have large companies that can take part of their assets down. That's changed a little bit with ArcelorMittal, but for the most part, people who have assets, they've spent a lot of money and their life is in those assets. They don't really want to leave the business. And then, again, to kind of Mr. Lee's point, historically, it's taken decades for the steel industry in overcapacity to take that capacity out. And I personally expect China will do it faster than the rest of the world because it is a command economy and they can just get things done more quickly than we can. China continues to export at an extremely high rate. I have to tell you, since I've been in Vienna, I added the Jack Ma quote. This is the CEO of Alibaba. He was on CNBC, and he called trade a human right. And he said, free trade, it's free. So maybe that's not how we perceive it, but the point is, when you're competing with others, you need to understand your competition's mentality because that's the only really way you can deal with it. And Mr. Lee just told us, we're at 115 million tons of exports probably for this year. They're targeting 80 million tons by 2020. So that's the number. Whether we like it or not, that's the number. So let's just manage to that number. And if they do less, that's great. I have my own opinion, and we'll talk about that in a second. But they told us what they're going to do. So China is not the only country that's making more steel than it consumes. So these are just WSA numbers, they're just doing a ratio of production to consumption. You look, the EU is about flat. So within the countries, they import and export. But as far as their total steel coming out of the EU to other countries, it's about flat. The CIS, if you want to say this, the most aggressive offender here, they're exporting almost as much as they consume. And then it's really kind of flat across the board. So if you look at the second set of numbers are actually countries. So China is exporting about 10% more than it consumes. Honestly, they're half of the global steel industry. So that's not an unreasonable amount. That's not an unreasonable ratio. It's a big number, which is why we struggle with it. But actually, if you're judging their performance compared to other countries' performance, they're acting just like everybody else. Japan is a little bit of higher export. South Korea now has moved into that list. India is about flat. The countries that are under consuming, and this is interesting because these are WSA numbers, and in the bar last night, the conversation I was having with some producers, they had Turkey actually exporting more than they consume. So I'm gonna have to go back and check those numbers. But right now, the under consuming countries or under exporting countries are the US, Turkey, and Taiwan. Okay, so let's talk about consumption. I've talked about this a couple times already. Global steel consumption declined 2.8% in 2015. This is why we all feel the angst. In 2012, 2013, 2014, we had a nice little bit of growth, and so we could deal with our problems because we had growth in demand. Demand is softened, and so now we're all scrambling to figure out what to do. So just for you guys, I threw in these numbers. I think we've actually seen them already tonight. Long products at about 838 million tons is still more than the flat products, so it's still got a benefit as far as how the steel products get broken out. The developing world obviously dominates that production, and we saw this from Kim, so that's just a repeat of what we already know. I put the bird cage in here because, the bird's out of the cage. We can't control the bird. What are we going to do? It's flying around the house. Chinese production in 2014, this is the last number that the WSA had, was 525 million tons of long products and 315 of flat. Presumably, people in this audience know, and I'll go into it for just a little bit, but there's a dichotomy in the Chinese steel production industry because there are large government-owned mills, but there are also still a lot of smaller mom and pops, we call them, and mostly there's a split because the flat products are really really made in controlled processes, and the long products are really more the mom and pops. So the government actually has less control over the long product side of the market than they do over the flat. Okay, so I use this a lot. China is capitalistic, except when it isn't. And our problem is we can't figure out when it's going to be capitalistic and when it isn't. As long as it's acting capitalistic, we can handle that, except for some of the subsidies that they have. But every country has its own subsidies. We can get into that discussion. But the truth of the matter is, if we could predict what they were going to do, we'd be a lot less unhappy. But the problem is we can't. So, you know, when billet prices start coming out and lower than the cost of scrap, we freak out because our capitalistic mind doesn't work that way. I do believe that the government will eventually enact policies to control their steelmaking overcapacity. And Mr. Lee just told you they were going to. It's just a matter of how fast and if they do it in the way that we think they should do it or they do it in their own way. And I will tell you, as an American, my father was in the military and we lived in lots of countries when I was young. And the truth of the matter is not every country does some things the way the USA does. And it makes us uncomfortable when they do it other ways because we think our way is better and we want to help them learn to do it our way because our way is better. So that type of thinking in a global market is really going to be the downfall. You just have to say, okay, I'm going to manage my business best for me. They're going to manage their business best for them. I just need to figure out what their behavior is going to be so I can actually prepare myself to deal with it, right? All right, let's see. One of the things I put in here to demonstrate the capitalistic thing, I was in Nanjing in 2008, and there were huge, huge lines of trucks at all the truck stops. And I was with an economic professor friend. We were over with a group of students, and I said, you know, China's a command economy. Why is there a shortage? It doesn't make any sense. I understand why there are shortages in the U.S. We can't plan anything, but they can plan lots of good things. Why is there a problem? So he's like, I don't know. Let's go find the store owner and ask him. And so we found the guy who owned the store, and he said, well, it costs me more to buy the gas than I can sell it for. And we were like, well, you can't be happy with that. What did you say? He's like, I went and I told them, I was like, I'm losing money on every bit of gas I sell. And they were like, well, you've made money for the last 3 years. It's your turn to give back. Okay. Again, we don't really relate to that in the U.S. In the U.S. or the Western world, we have to earn a return on capital. We have to pay our bank loans. We have to pay our taxes. So this whole concept of, I'm giving you all the money you need, so why are you complaining that you're losing money? It's just foreign to us, and we can't predict it. We can't predict when it's going to happen, and so therefore, it's a surprise, and surprises are bad, and so that's where we have our angst. All right, let's just see what else I had in here. Okay, and we talked about this a little bit today. There have been reductions in the steel industry, but the additions basically have offset those reductions. And part of the long product capacity, which came off stream when the prices were depressed, really has come back on now. So for the moment, at least, it's a wash. And to the gentleman's point here, it's a big, big number. Until you actually get to a number that's relevant, it doesn't matter anyway. So let's see. So there has been an impact, though, in the coal mining because there are shortages now of coal. You've seen some price run-ups. Everybody's speculating what's going to happen with coke. So for whatever reason, it seems like those capacity cuts have really happened. I will also say, and we studied China a lot at World Steel Dynamics. Their political system, their management system is completely opposite of the US's. You know, in the US, when a president comes in or when a CEO comes into a company, you have about 18 to 24 months to actually impact change. After that, you lose your effectiveness. China's exactly the opposite. When they bring in their new 5-year plan and put in their new managing directors, whatever you want to call them, the first 2 years, they don't really do too much. They kind of figure out what's going on, they get their feet wet. In the last 3 years, they do a lot. So if you're down to 18 months and the objectives of your 5-year plan haven't been met, all of a sudden actions get more radical. So that's just a difference of thinking the way, so it pays to track what they said they're going to do in their 5-year plan and then to that last year, look at where they are in making that plan because they're going to get more aggressive usually. And then we talked about this regional and national objectives don't always align. I will have to say, before the current ruler, there was a lot more divergence. It's become less safe in your life to not listen to whatever the central government's telling you to do. There were a lot of people that were eliminated due to corruption. We talked about this last night in the bar. The problem is that something that was perfectly legal yesterday can be illegal today. So again, even we can't really predict what they're going to do. Sometimes in their own country, they can't predict what's going to happen. And so people have gotten a lot less aggressive in doing things that normally used to be okay. So, and that's then caused their economy to slow down, because if the process that you have to go through, all of the administrators are scared to approve your process, now things just get held up. So we've seen a lot of discussion about China. We've seen a lot of discussion globally because they're relevant. It's so interesting. When I started at World Steel Dynamics in 2003, a lot of the conversation was, oh, when is China going to join the World Steel Association? When are they going to become part of the globe? And so now they have. We asked for this. And so now we're all like, oh, when is China going to leave us alone? So again, the reality is it's not an easy solution. It's complicated. Issues are interrelated. It's not just about steel. It's not just about trade. So I happen to think there are a couple of, so it's interesting, take a step back. We know that the Chinese steel mills have lost money for the last 18 months to 2 years. We know that they're not stupid people. We know that there is something to be said for keeping the population employed, but the amount of money that they lost in the last 2 years, they could have spent that money doing lots of other things, keeping those people employed. So why are they dedicated to continuing to operate their steel industry the way they're operating? There's got to be something else going on, right? That just begs the question. So what's going on? There's a couple things. They want the RMB added to the global trade currency bundle, and the criteria for that happening is that they have a significant portion of global trade. So they can't control the consumer side of their exports. You know, their container shipments are off significantly, but they can't control how much steel they sell. There's nothing in the rules that says they have to sell it at a profit. It's just about the actual percentage of global trade. So that's one possible explanation for why they've kept their steel exports high. They're on track for that to happen. The IMF announced last year that they would be adding them to that basket at the end of this year. It was earlier than people expected. So from my perspective, again, all I care about is the steel industry, right? It's like, okay, fine, let's get that done, because then that'll remove that incentive for you to continue to export at a loss, at least on steel, if that's why you're doing it. The second thing is the market economy status. And we already had a question about the market economy status. And I did a little digging. So when China joined the WTO 15 years ago, it was a game changer. So China and the EU, I was surprised at this number, they conduct €1 billion a day in trade. That's a huge number to me. There were 5 criteria at the time that were stipulated if, in fact, China met those criteria, that at the end of this year, on the 15-year anniversary, they would be recognized as a market economy. So those criteria I listed here, it's barter trade, government non-intervention, transparency and governance, the property law and bankruptcy reform, and establishing an independent financial sector. I'm not sure anybody in the West believes they've met these criteria. But that's the debate, right? Clearly, North America has come down saying, don't do this, this is a mistake. Europe apparently is divided. So the consumers of steel and the consumers of products think that China should be recognized because they like that source of supply. The producers and other people maybe don't agree with that. So it's just the jury's still out on whether how that's going to fall out. So switching subjects a little bit, China isn't the only country supporting its steel industry. I didn't put an inclusive list, but here's a couple of examples. You know, Russia has provided financing to some of its companies in trouble. I hear that they give their natural gas for free. I haven't verified that personally. You know, when natural gas was at $15 per MMCF, in the US, we would have really appreciated that. Our natural gas cost has really dropped a lot, so that's kind of at least good for us. Ilva in Italy, basically the Italian government is trying to find somebody to come in and take over that operation. The United Kingdom was just in the news with the Port Talbot deal. Germany is talking about wanting its ThyssenKrupp not to get involved in the UK. They prefer that they get involved in Salzgitter. Canada's trying to sell its Hamilton Works because US Steel has decided not to operate there. So the whole point that I'm trying to make is we ignore all of our faults and pick on everybody else's faults. But the truth of the matter is most countries are supporting their industry, their steel industry to some extent. We all know this. There's a race for survival. What are we going to do? Again, one of the things when China joined the WTO, it took some, at least in the US, because I don't know trade law that specifically, but it took some of the tools away from us, because some of the tools we used to use in the past, in the 70s and the 80s, now are actually technically illegal based on our trade relations with the WTO. So everybody's trying to figure out what tools we do have available and how we can progress down a new path. And in fact, in some of the recent US trade cases, China just didn't even participate. And I suspect that's because, first of all, what he said, there were 377 trade cases against them this year. First of all, I think they viewed it as a distraction. But secondly, I suspect that their lawyers were telling them that they could actually appeal it in the WTO. So whatever we decided to do in the US maybe isn't the final decision. And it's so fascinating because we were talking about what was happening with long product suits, and we'll talk about suits in a second. But in fact, in the US, the threat of a suit or the suit going forward actually moves everybody to the sidelines. So product flows do go down. And the US is a lot stronger market right now because a lot of the inventory overhang has been worked through that was sitting at the ports. But, I mean, I have friends on the Northeast coast who've got the product on the water that's going to be arriving in the next 2 months. So eventually, workarounds come to pass, and so maybe the level of flow is not as high, but in truth, you're never going to stop all the flow. All right, so what else is on here? So I've had a number of people in the last 2 months ask me, nudge, nudge, hint, hint, what's going on with Korea? It seems like they don't ever get included in all these problems, and I showed you that they're basically an exporter now. The truth of the matter is if there's any issue globally that our government, my government in the US, needs to resolve with South Korea, they're going to throw the steel industry under the bus in a heartbeat, no question. I mean, the steel industry is not relevant enough. It's not big enough anymore. It doesn't have enough jobs anymore. It's not a big enough part of GDP anymore. So what was fundamentally a foundational industry to the US 50 years ago, it's not anymore. And again, I'm saying that, first of all, it breaks my heart because I'm in the steel industry, right? So about 10 years into my career, when I first started having investors recognize my ability to contribute, they were like, oh, we love your work. You're a great analyst. We really appreciate you. Go follow something else that's relevant. I was like, really? Really? I've spent my whole life and soul in this industry. So, but the truth of the matter, as managers in this industry, we just need to understand we don't have the clout we used to have. So we have to learn to manage our businesses under this new reality. Okay, trade actions. I just grabbed SteelOrbis, did a webinar a couple of months ago. I just grabbed some screenshots. This is just a few of the trade filings we've already discussed, a case a week, whatever it is. I mean, it's just the new reality. Everybody's trying to figure out what they can do to protect themselves because everybody's suffering. There's just too much steel. It's a trough. All right, so, M&A. Murat asked me to talk about M&A. And one of the things that happens in a trough, surprisingly not as much in this trough, in 2001 and 2002 in the US, we had almost 100 companies go bankrupt. We really haven't seen that so much. I mean, people are struggling, production's been stopped, but it doesn't seem to be as punitive as it was before. But this was just a list of some of the products that are being sold or being shopped or whatever. I have to say the very last thing, and we talked about this in the bar last night too, Mingo Junction, which is a pretty small producer in the US, has actually just restarted. So until the assets actually get dismantled and melted, they're probably coming back at some point. It's a cycle. We're in the trough. In 3 to 5 years, when the prices are high, people will go, oh, where's that ghost plant, right? We talk about ghost plants now. I think probably in China, those assets won't come back more likely than in other countries. All right, so we talked, this was alluded a little bit, but I'm gonna make my own spin on it. One of the things that frustrates us about China and our new reality is we can't predict how things are going to go. And one of the things at World Steel Dynamics, if you guys know Peter Marcus, he's famous for his odds. And so what we used to look at around the world is what country was the low-cost producer, mostly due to currency, but also due to raw material availability and some other things. And as the low-cost countries would get full, or sell out for the next 2 months, then you would have higher odds that the prices were going to go up, right? Because if Ukraine was sold out and Mexico was sold out and, I don't know, pick another low-cost country, then they didn't have any of those cheaper, any of that cheap steel would come off the market, so therefore the price would go up. So this last 2 years, the relationships between products, both on the raw material side, but also like in the US right now, the price of hot rolled band has been very, very low because there's lots of hot rolled band around, but the coated lines are sold out. So the price of coated and galvanized is at a huge spread to hot rolled band historically. So those kinds of things, as an industry, we don't like it when those relationships change because we don't know how to manage. So for instance, my trading friends in New York at one point were saying they couldn't sell any scrap out of Taiwan because everybody had shifted to Chinese billet. Now the Chinese billet didn't really work as well, but the truth of the matter is if you were at a $30 or $40 or $50 a ton cost disadvantage to use scrap, economics predict that you would actually move. So recently though, because you'll see basically, so I'm looking at the far right column, which is the scrap spread, billet to scrap. So that spread had dropped from about $200 a ton down to almost 70. It's recovered a little bit for this year, and for this month it's actually back over 125. So presumably those relationships are kind of flushed out. One other thing I'll say, because historically the U.S. has been an exporter of scrap, and after the tsunami in Japan there was a lot of scrap available, and so we kind of got displaced a little bit. And then the other thing is our dollar, our currency has been strong, not because our economy is strong, but it's a safe haven. People run to it. So I've heard it said it's the cleanest shirt in the dirty laundry, basically. But what it does is it ends up making us uncompetitive in the market. And I laugh because, you hear U.S. producers complaining about it now, but when the euro was strong 2 or 3 years ago, 2008, 2009, 2010, we happily took Europe's business. We didn't go, oh, we won't compete with you because, you're at a cost disadvantage because of currency. So I will make the case that as a business practice, you should be seriously looking at the currencies in the major markets that are supplying product into your products, because a currency shift can make a country much more competitive or make a country much less competitive. And in the steel industry, one of the frustrations, and it's not really talked about a lot because basically we focus on other things, but our industry has become less competitive because of monetary decisions that our Fed and our government have taken that were through no fault of our own, but now we're having to compete at a cost disadvantage. So that's the reason I put that in there. One of the things I constantly say, I'm a low-cost producer proponent. I'm always going to tell you need to keep your costs low. I'm also going to tell you need to never be comfortable with where you are. You need to be always looking at how do you make your business better, how do you implement new technological changes. I think New York taxi cab drivers are a perfect example of this. They had the market completely locked up. They were horribly arrogant. It was hard to get a cab to come if you needed one. If it was raining, it was impossible. And then Uber came into the market. And now all of a sudden, taxi cabs are very accommodating. They'll go to neighborhoods they don't like to go to because they're being forced to compete, right? So when you don't actually have to compete, you get into your own little world, you get into your head, you kind of feel like you own the space. But in fact, you need to be developing new technologies. In the steel industry, we're really bad about this. I think the last developments were really 15 or 20 years ago. It's fascinating. You guys probably don't know a lot of this on the long product side. But in the flat product side, a number of the steels that are being sold today, the ones that are competitive with aluminum, weren't even in existence 10 or 15 years ago. I know in the U.S., the way we make long products has changed because the mills were underutilized and ferroalloys were expensive, so people learned how to quench to get the product properties that they wanted because they had time to do it. So I'll just challenge you to kind of always be challenging yourself to look at what the new products are, what the new options are, and to be looking at those trends. Okay, so I think I've talked about most of this. I just threw in a couple of things. We need stronger global economies. We need the pricing bottom. I think we are at the bottom. I have to agree with Kim on that. But I don't see what propels us away from the bottom. So we could be here for another year and a half. I don't know. I'm hopeful 2017 will be better, but who really knows? That's going to be Brexit. It's going to be in the U.S. It's going to be. I have to tell you too. In the U.S., I have both a microeconomic survey that I do and a macroeconomic survey, and I do color maps, basically. And they're split. It's about half and half. I do in-market surveys. I mean, for sure, mining is not going to come back anytime soon. The ag market is a 3 to 5 year cycle. It's probably not coming back anytime soon. Yellow goods are problematic. Energy is maybe improving. I've heard that one mill that was operating at 5% of capacity is operating at 35%. Woohoo! You know, so I mean, until you get an auto, probably in the U.S. is not going to go down, but it's not going to keep growing. So you just have some of these issues. The end markets are just not strong enough to propel us out of our problem. Natural solution, evolution, right? Survival of the fittest. There's going to be disruption. I think we need to continue to develop new steels, if for no other reason than competition with other products. On the plane flying to Vienna, I was beside a man who works in the nuclear industry, and it turns out that actually balanced materials now, they don't know how they're going to act over the next 50 years. So that's the big challenge. They've changed how they make concrete. They've changed, I think in the US, people are going to coated or stainless rebar so that bridges will last more than 60 years. So there's these evolution things in the market that we just need to be aware of. And I'm always going to say you should be a low-cost producer. If you're not a low-cost producer, you need to figure out where you can take costs out, because you're always going to be vulnerable if you're not. This is just a little bit about what I do. Basically, I work for friends. We'll work for money. You tell me what you want. I can figure out how to do it. I worked on Wall Street long enough not to put up a disclaimer that says, don't believe a word I say. Oh, and I changed this picture last night. My friends laugh at me because wherever I go, I'm looking for construction cranes. So this was driving around Vienna yesterday. There's lots of construction going on here, which is actually an encouraging sign. You know, when I don't see construction cranes now, I'm all like, oh, the economy's depressed. But construction is actually a really strong highlight of the globe right now. It's amazing. Anywhere I go, I'm finding construction cranes. So thank you so much, and I'll turn it back to Murat.
Thank you very much, Becky. Very detailed, very nice presentation. Really appreciate it. We are a little bit behind the schedule, but I believe it was really worth it. So thank you very much for your attention. Any questions from the floor at this point? I have one question myself. You have also talked about this merger in China, Bao Steel and Wuhan. And Mr. Lee also mentioned that there could be others coming in. Yeah. Do you? What's your opinion? Do you think these mergers will help the issue of overcapacity, excess production, or they will create more efficient, more competitive giants in the industry?
Yeah. Again, you know, in the Western world, when mergers happen, efficiencies get taken out. So the question that you have to ask is, in China, are there efficiencies that can be taken out? And will that happen? I mean, I think obviously China's trying to accommodate what we're all saying, which is you need to consolidate. And I appreciate that, but I don't know how much it's really going to do ultimately. I mean, I don't know how much it's ultimately going to do. I think they're already making those changes. I mean, steel mills have moved from provinces. They've moved from the inner part of the country to the coast. It was interesting that Mr. Lee's explanation for the fact that they've moved out of markets that don't need the steel anymore. That's an interesting concept that I had never heard. So, I mean, I think that, I do believe that China's going to get its act together. I do think it's going to happen faster than it would in our countries. But I mean, whether the mergers necessarily are integral to that, I think that's a tool that they're going to use.
Thank you. Any other questions?
Lunch?
Yeah, probably. Thank you very much indeed, Becky.